for having me. I'm going to talk today about mortgage rates. You already know mortgage rates are high, where it's going to go going forward, real estate and a recession. And that could actually be a good thing for mortgage rates. Let's get right to it. Inflation. Inflation is the enemy of low mortgage rates. So last couple of years, we have enjoyed low mortgage rates because of the pandemic. The Federal Reserve jumped in and put a whole lot of money into the system and rates were low. But now the economy is a lot hotter and inflation is the enemy of low mortgage rates. So what is inflation exactly? Put an example is higher prices. So if you filled up your car last year for 50 bucks, this year it's a half a tank. And if it gets out of control, next year it'll be a quarter of a tank. So your money is being devalued while prices are going up. So what can the US government do? The Federal Reserve is part of the US government. They're in charge of money supply. So what they do is they hike rates up, but mortgage rates are not tied to hiking the Fed funds rate. So we'll talk a little bit about that. We'll talk about the balance sheet, which is really a big savings account for the Federal Reserve. And they buy up mortgage-backed securities, mortgages, and keep them on in their balance sheet. And that's about $9 trillion. We'll talk about that. And the recession, is it coming? Well, we got to go by historical facts. And historical facts and all signals say, yes, a recession is coming. So let's go through it and why. And let's make a case. Let's make a case for higher interest rates and lower mortgage interest rates. So we got to go back all the way back to 1978 to 1982. That was a period of high inflation. What did the market do at that particular time? Well, the Federal Reserve was governed by Burns, who got ousted, and then Ronald Reagan put Paul Volcker in. So inflation at the time was 7%, and it jumped all the way up to 14%. So those of us who remember, I remember being in the car with my mom in a Pinto waiting in line for gasoline. So there were supply chain issues back then, just like we have supply chain issues now. What did mortgage rates do? Now, this is a very important point here. Mortgage rates jumped from 12% to 18%. So the difference between 12 and 18 is 5. I want you to keep that in mind, 5% difference. It jumped. The Fed funds rate, which is a rate that banks borrow from the federal government that affects credit cards, HELOC, car loans. It doesn't affect mortgage rates. Went from 11% to 20%. Inflation then was beaten after they raised rates and they tried to stamp out inflation. Inflation fell from 14% to 5%. Mortgage rate responded as well because we headed into a recession, and then it jumped down to 18% to 12%. It didn't bode well for the stock market though. The S&P 500 was down 30% during that period of time. So stocks took a big hit, all right? So everybody remembers Alan Greenspan before the market crash, right? Alan Greenspan was on TV almost every day. What did inflation do back then? The inflation rate was a paltry 1.1 3/4, and it reached the 2 and 3.5. Now, the federal government really wants inflation running at 2%. So anything above 2%, they kind of get nervous about. So 3.5%, they had to make some moves. Mortgage rates jumped a little bit, 8.5. We will take a 1.5% jump today, right? Because we're already past 2.5. So it went from 7 to 8.5%. The Fed funds rate from the rate that banks borrow is 4 3/4, went to 6.5. What happened to inflation after they raised rates? Rates went down 3.5 to 1%. Mortgage rates followed, lost 3 points, 8.5 to 5.5%, and the stock market crashed, right? The S&P 500 was down by 50% during that period of time. So here we are. Jerome Powell was appointed by Donald Trump and kept on by President Joe Biden. And that just goes to show you that they just want the economy running. They don't care what kind of political atmosphere is going on. They want the right person for the job. So we'll see, right? So we have 1.5% inflation was at the beginning of the year, right? 1.5%, and then all of a sudden it popped along with interest rates. So it went up to 8.5%. Oh, that's well above 2%. So they have to do something about it. Now, here's the interesting part, and this is where you have to take a swallow. 2.5% is where the bottom of the mortgage rates were. We're at 5%. Now remember the spread here. That was 5. It went from 12 to 5. We're only midway through rates going higher based on history, right? So that will leave us at a 7.5% clip. Now, when they say 7.5%, Those are borrowers who are putting 20% down and have 740 FICO scores. Those are not the borrowers with 3 and 5% down. Those are not the beginning first-time home buyers. Those borrowers are already close to 6%, if not 6% right now, right? So the Fed funds rate was at 0. They raised the rates 0.25%. They're about to raise the rates, the Fed fund rates to 0.5% for 3 quarters. At the end of their tightening, the Federal Reserve should be around close to 3%, maybe high 2s, 3%. Where's inflation go? Once inflation drops, mortgage rates will drop if history will repeat itself. Stock market is still booming, it's volatile, but it hasn't fallen 30% or 50%. So those are to be conclusive, but you gotta watch the tea leaves, right? So federal hikes. Let me just show specifically what happens. This is mortgage rates going down. Here's a federal hike here. This is 2016, right? The last time the Federal Reserve had to jump in and deal with interest rates and deal with inflation or a slowing economy. So they hiked the rates, the Fed funds raised 0.25%, mortgage rates went down. Here, it went down again. Now you talk about inflation here, rates go up and they're attacking it. They're attacking it again, mortgage rates goes down. Then they talk about the balance sheet runoff, meaning the Federal Reserve will jump in and purchase mortgage-backed securities. Mortgage rates trade every day. They go higher and lower every day. They're just like the stock market. So they jump in with their money and they purchase those mortgage-backed securities and keep them on their balance sheet, keep them in their savings account. That market again is $9 trillion. So, but they're saying, hey, we're gonna not buy any more mortgage-backed securities. As a matter of fact, we're gonna let everything just run off. So let's say I purchased a house in 2020, the Federal Reserve bought those mortgage-backed securities, and now they're saying, okay, Rouvaun, you refinance your house, you pulling cash out now, we're not gonna purchase that. We're just gonna let that naturally run off, right? So just to talk about it makes rates go up, just to talk about it. Now they're hiking, they're trying to fight inflation. And then here, there's 8 rate hikes here. And then finally, inflation signals say, hey, inflation is going down, then mortgage rates fall. They fall precipitously, right? Until they say, hey, no, we're gonna slow down. We're not gonna let the balance sheet run off. And then they stop letting the balance sheet run off and then rates fall and fall again. Let me dip here and they fall again. So that's how it works. That's where we're at right now. We're sort of like over here. They're gonna announce, the Federal Reserve is gonna announce about whether or not they're going to let the balance sheet run off this week, right? So recessions, how do we tell that we're going to go into recession? Well, there's a treasury market, there's stocks and there's bonds, right? So there's a 10-year treasury bond, there's a 2-year treasury bond. If you borrow for 10 years, I want more money. So those rates tend to be higher than the 2 years. But when the 10-year is lower than the 2-year, something's wrong, right? So that's what they call inversion. So if you look right here, that's an inversion. Let's keep going. Let's go throughout history. Every time there's an inversion, there's a recession. These shaded areas are recession periods throughout our history. So inversion here, recession. Inversion and recession, 90s, late 80s. There was a recession a year and a half later. Recession, 2000s, we know what happened in the crash, right? All of us are remembering that. There was an inversion right before that. And then there was a recession, a big one. That was led by housing. I'm gonna show you the difference. All right, and this is 2020, just before the pandemic, and then there was a recession, right? Let's keep going. Unemployment. Well, unemployment is 3.6% right now. It's really low, right? However, after every bottoming of the employment rate, there's a skyrocketing rate. And for African Americans, you got to remember, we're double of what the national average is. So it doesn't bode well for us in terms of employment numbers. So if the national average is 3.5%, that means we're probably at around 6.5%. So you have this, and you have a bottoming out, and then you have a rise, and then you have a recession right at the bottom. You can see it here. This is going all the way back to the 50s, to the 60s. There's a bottom here. Employment rate pops up. Bottom here. So let's get to where we are now. Let me move my head. We're bottoming out here. This is right now. I mean, this is just before the pandemic. And then, of course, unemployment skyrocketed right at the pandemic, right? We're about to bottom out again. We're about to repeat this pattern. I mean, this pattern is not going to change. It's not going to just go a straight line from here on out. It's going to keep moving. Right? So what does that do with sessions with interest rates, mortgage interest rate? I'm a part of the mortgage committee. I should know this stuff. So let's say 1980, biggest part of inflation, and they started raising interest rates. Recession hit 16% to 11%. Then it went all the way to 18%. Your parents and your grandparents are talking about, I bought a house at 18%, but it was only like $50,000 back then. So, you know, not 1.1 million in San Francisco. So you got 18%, it goes down to 13%. This is when I got into the business, 11% down to 8.75%. This is 92. And then you have the dot-com bust, 7% to 6.375. And then to where we are present day, it went down to 3.75, all the way down to 2.75. And this slight rise right here hasn't been seen since 1994, this rise right here. So again, this is not going to be a straight up, but at some point in time, it's going to come back down. So recessions actually help mortgage rates. Now, who hasn't heard that I'm going to wait until there's a crash? Everybody, right? You know why? And especially come from us, Black folks, because we were affected by the crash more than any other group in America. So we have a PTSD for that housing market crash. And so that's in the back of everybody's mind. But if you look at housing and what it's done through recessions, there's only been one time where there's been a crash, and that was the last one. All right, so in the 60s, housing prices was pretty flat. 70s, they started to rise over the decade. In the highest period of inflation before, during the 80s, the early 80s, late 70s, appreciation rose through inflation, right? So that's not true. So we go through the 90s and the 80s, it's relatively flat. Look, appreciation is supposed to be a healthy appreciation is 3.5% to 5% a year. That's where the federal government wants it. Not 18%, not 30% like it is in Phoenix. They want 3.5% to 5%, and they're going to get it. And by doing it, by raising rates, they're going to destroy demand and affordability in terms of rates. And when they do that, that's going to slow down housing. It won't be a crash because we, in this market right here, before 2000, with this recession and housing prices coming down, that was because of bad mortgages, stated income, stated assets, different kind of products that are illegal today. They no longer exist. We just spent the last 2 years refinancing everybody into 2 and 3.5% rates, right? So they're not going anywhere unless they have to, right? So it's a completely different market. There's low inventory. Knock on wood. Everybody knows there's low inventory, right? So during the last time in 2007, there was 3.7 million houses for sale before that crash, right? Now there's 950,000. There's less than 1 million all over the United States. And I was talking to Ashley Thomas. He had a $550,000 house in Compton with 41 offers, and rates are still at 5%. 41 offers. So it's not hot, and the federal government, the Federal Reserve wants it. They want the housing market to cool. And again, we have rates. If they can get up to 7.5%, they will. They're going to cool that market. 14 million less households in 2007. 14 million more households, 3 million less houses for sale. So the millennials, demographic-wise, they equal or surpass the baby boomers. They all of a sudden mature. You know, like 5 years ago, they said the millennials were going to rent their apartments until they turn. Well, that's not true, because when you start making families and babies and everything, you want a house, right? This is America. So there's 14 million more households than there was in 2007. So what do you do now? We know interest rates are going up. They got room to go up even further. And we're in a rising interest rate environment. Most of us who entered the business in the last 10 years have no clue what that looks like. So what do we do? Well, first thing is many borrowers are going to start paying points. Just like the realtors make 3% on the transaction from the seller. That's 3 points, right? 3%, 3 points, right? So they pay a point now for a mortgage rate. versus no points. So if no points is 5.5% and 1 point is 5%, they might take the 5% so they can qualify for more HODs. Intermediate arms, they're going to make a comeback in terms of greatest share of the market because it's a lower interest rate. I was pricing an arm out for a customer yesterday, and a 30-year fix was 5.5%. They can get a 10-year fix, meaning it's fixed for 10 years for 4.5%. I can ride it out. If they have 10 years to wait for rates to come back, they will, right? So there's going to be a greater percentage of people that are going to take intermediate arms, and the borrowers can just wait for the interest rates to come back down. FHA is talking about a 40-year term loan. Forget the 30-year, stretch out the payments to 40-year term, right? That's a lot more interest to pay, but in terms of affordability, you got to come up with something, right? Because prices are not coming down. There's new innovative products like lock and shop. Usually it takes a property to lock a loan. You got to be in contract at least, but now they're saying, hey, you don't need to be in contract. We'll lock your loan, and then you can lock and shop for a house for 60 to 180 days. New innovative products. That wasn't there before, all right? Purchase with cash. There's these programs right now where you can pretend like you're a cash buyer and really have a loan back behind you. So there's innovative programs that are going to come out in the next 6 months. Every time there's a rise in rates or pause in the market, the mortgage market reacts and comes out with different type of products for people to afford homes, because homes are fundamental to the economy. All right. So, as you know, Black people, especially, reverse migration. People are going from leaving New York and California and going to Texas, Atlanta, Florida, North Carolina. They're going back to where their roots were, right? And there's going to be, that's not for everybody, but there's a percentage of us that are doing that. And we're incentivized because home prices are really high and affordability is there. So in conclusion, mortgage rates should continue to rise for most of 2022, not in a straight line, so we can take advantage of the dips. And then once inflation is beaten and the recession has started, expect rates to fall from their highs, right? Just like we saw in the charts before. Affordability will remain an issue. It is up to safe, innovative mortgage products and more supply to help the cause, right? That's it. I'm Rouvaun Walker. I'm the chairman of the Mortgage Committee. Thank you. Any questions that you may have in the chat, please ask.